I think the price of silver and copper and platinum and all commodities would go up a lot, but I'm not sure the US government would officially revalue silver. They would just revalue gold, and that would drag silver, platinum, and copper along with it.
Silver is a much smaller market than gold, so a little bit of money coming out of gold would make a big difference to the price of silver or platinum. And silver's one tenth of gold in terms of market size, and platinum is one tenth of silver. I talk very broadly speaking.
Yeah.
So any money going out of gold into those other metals would drive the price completely crazy. I think prices will go higher for the same reasons they've always gone higher, which is monetary debasement, and that's the reason that gold is going higher because they keep printing money.
Talk of gold being revalued to astronomical levels, $100,000 or even $150,000 an ounce, continues to circulate among analysts and hard money advocates. Mario Innecco and Clive Thompson say it sounds appealing, but the reality isn't so simple. The theory goes like this. If the US government revalued its official gold holdings high enough, it could cover its $35 trillion national debt in one stroke. But Innecco and Thompson argue that in practice, it wouldn't work. For one, setting gold at such a price would create powerful incentives. Everyone, from miners to private holders, would rush to sell their gold to the Treasury, flooding the system with a new supply. That would undermine the whole plan. They point out another wrinkle. Countries like China and India, with massive gold reserves, would see their holdings soar in value overnight. But the flip side is they'd suddenly struggle to buy additional gold, since prices would be out of reach. That means swapping US Treasuries for gold would no longer be a feasible option. Some suggest gold revaluation might not happen in isolation. Instead, it could be tied to the rollout of a central bank digital currency. Governments might peg a new digital dollar to gold as a way of restoring trust while phasing out legacy cash and even sidelining treasuries. Clive Thompson notes that Judy Shelton once described how the mechanics could work. The Federal Reserve could transfer its gold certificates to the Treasury. The Treasury would then revalue them at a higher price, and the Fed would credit the Treasury with the difference. In effect, new money would be conjured out of thin air. For Innecco and Thompson, that highlights the paradox. Revaluing gold may look like a silver bullet, but it risks creating just as many problems as it solves. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that understand what's unfolding. Thanks for watching.
I don't think they would pay off the whole debt personally. That would be, really inflationary, in my opinion. And they don't really need to do that. But if they did, gold would be like, it would be like a massive bull market.
It would have to be $150,000 or $140,000 to pay off the national debt. But of course, they can't just pay it off because this debt, some of it doesn't mature for another 30 years. So legally, you can't, illegally you could, but you can't legally go and say, we're changing the terms of your contract. You've got a 30-year bond at 5%. Well, actually, no, you haven't. We're giving you the cash now.
Yeah, it would be like a default, I would say. So yeah, it would be very chaotic, I would say. Uh, it would be good for people who hold physical gold and silver, though.
Well, it'd be good, but the other trouble with that, at a certain level, everybody's going to be mining gold in their backyard, and there's going to be an awful lot of gold coming out of the ground to be sold to the US Treasury. And I think, it'd be a good move for them to revalue gold at a higher price than today. And therefore they would suck in some gold, but they don't want to suck in so much gold that they're totally overwhelmed by it.
Some people speculate that China holds like a lot more than the 2,300 tons that they profess to hold. I guess it would help India as well. Indians hold a lot of gold, not just the government. What do you think?
Well, yes, it would help the value of whatever reserves they've got on the books. But the downside to that is, as we know, many of these countries are actively buying gold month after month, year after year. And this is going to make it a lot more expensive for them to convert their US Treasury holdings into gold. They won't be able to get as much gold for their Treasury holdings as they get today. So in a way, they'd be happy with the revaluation, but they'd be unhappy that they can't do anything with their treasuries now except at a much worse price.
And also, if you go on fxtop.com, and you do gold, the dollar versus gold, a gram of gold from August 15th, 1971 to now, it says it's dropped 99%. So yeah, and I think in 1971 it was 35. So I guess the day the dollar, the currency collapses and the other currencies will be the day, Clive, that you can't buy any more gold with the dollar or the euro or the pound. It's what's happened in Venezuela that you can't even buy anything with their currency. I saw a program that they even use Colombian currency in Venezuela.
Well, we nearly had this situation in 2008. I mean, I was working in banks, a bank in 2008, and uh, it was very common for clients to ring up and buy gold or sell gold, and they'd buy physical gold bars, which we held in custody on their behalf. But as Lehman Brothers went down, the phones started ringing off the hook, people saying, maybe your bank's going down next, I'll buy gold, please, because
Yeah,
the gold would be in custody, it wouldn't be a default of the bank.
yeah,
So I'd ring the Forex dealer and say, I've got a customer who wants to buy 10 kilos of gold, 20 kilos of gold, whatever it is. And the answer came back, well, he's going to have to wait because our normal suppliers are completely out of gold. They have to manufacture it, and it'll take 2, 3 weeks before we actually get restocked. Or not, we get restocked before they get restocked. They can't deliver it. And the reason it was they're out of stock, because normally these banks, they have huge stocks of gold ready to be delivered. But when everybody comes on the same day saying, I want some gold, the shelves are empty. And, they had to manufacture the bars. So a lot of clients were very distressed in that 3 week period, worrying whether their bank, the bank I was working for, would go bust in the
yeah.
interim. It didn't go bust, but that was the fear.
They won't revalue gold without launching a digital dollar and pegging gold to it afterwards. Then they can control foreign debt by exchange, thereby controlling the euro-dollar system. Yeah, I mean, the euro-dollar system, the euro-dollar is like basically a dollar market outside the US. So, yeah, I'm not sure how, yeah. I mean, the way to control the euro dollar system, which is dollars flowing around outside the US, would be to impose capital controls. And I don't know if they want to do that. What do you think, Clive?
Well, the Weasel's Apprentice who wrote that, he's incredibly perceptive because I think he's hit the nail on the head. Because what he describes is a high probability scenario. I think we will get a digital dollar and euro and Swiss franc and pound and yen and everything else. I think it's coming, and at some point there's going to be a crisis. They're going to restore faith in the currency. They're going to link it to gold, and they're going to tell you that all your other money, which is not already in digital pounds, can't be converted. So you're left behind in a situation with two currencies, one which is convertible to gold, which you might be allowed to have £20,000 worth or $20,000 worth, and then you've got your 100,000 or million or whatever you happen to own in T-bills or cash or gilts or bunds or whatever it happens to be. And unfortunately, that's now a defunct currency because to all intents and purposes, you either need permission to convert it to the digital gold or you can't convert it at all.
Yeah. The other thing I wanted to mention about the bond market and the fact that yields are, especially in the longer end, like 10, 30 year, are rising, like in Japan, the US, Germany, the UK, is that, Clive, a lot of financial institutions, especially banks, they hold a lot of these bonds because well, they consider that risk-free. It's always worked in the last 40 years, and they think it's going to keep working. I think it's really dangerous. I think we could see a major banking crisis if these yields continue to rise, as I think they will. And what that will mean is your deposits in banks are not going to be safe. And when push comes to shove, the governments and central banks will bail them out again, and they're going to print and print and print. And it's one of the reasons I will hold on to gold and silver as long as I can, and I'll try to get more and more. Not because I think they're going to revalue gold, the US government. That's not the reason why I own gold and silver. It's because of that. And because this revaluation talk, Clive, has only started since Trump has come into office. So it's something new. I'm not saying it's not going to happen, but if it didn't happen, I wouldn't be annoyed about it.
Well, Judy Shelton spelled out in words of one syllable as to exactly how it could happen in the Bitcoin bill, which didn't pass into law, by the way. It's when the committee never came out again. But in the Bitcoin bill, basically and it's written there in black and white how it'll work to revalue gold. Basically, the way it's worded, I haven't got the wording in front of me, in front of my eyes, but it says the Treasury shall or no, the Federal Reserve will tender its gold certificates to the Treasury, and within 6 months, the Treasury will tender the market value of the gold back to the Federal Reserve, and the Federal Reserve shall pay to the Treasury the difference between the value of the two certificates. In other
Yeah.
words, creating some money out of thin air. So that was, that was obviously based on the revaluing at 3,300 in her bill. But of course, they could change that number to whatever number they like. And the higher the number, the more money the Treasury gets.
Mario Innecco and Clive Thompson push back on the idea that gold itself drives inflation. Gold doesn't make the price of bread or gasoline jump. What fuels inflation is monetary expansion, when governments create new money and pump it into the economy. That's where gold revaluation comes in. If governments suddenly marked up the value of their gold reserves, those holdings would be worth far more on paper. That would give them the ability to borrow and spend against the higher valuation. The catch is that once new money enters circulation, the supply expands and prices start to creep up. But the effect wouldn't be immediate. Historically, consumer prices have moved much more slowly than asset prices, such as gold. Innecco and Thompson note that some analysts believe a reset of this kind would only come in the middle of a crisis, after a market crash, a banking panic, or a deflationary shock. In that environment, revaluing gold would act like a jolt of liquidity. It would shore up government balance sheets almost overnight, giving policymakers breathing room. But that liquidity doesn't stay contained. Over time, it filters into wages, rents, and everyday costs. The difference is that instead of the gradual inflation we've lived with since 1971, it would all be compressed into a shorter and far more chaotic period. Let's get back to the interview.
Back in the early 70s, the ounce of gold was like 17, 16 pounds. Now it's almost 2,500. I know it's been over many decades, but if it's backed by a digital currency, yeah, people can still buy gold. They'll be able to buy a fraction of an ounce or a gram. A gram would be like 5,000. No, 5,000. Yeah, it would be like 500 pounds the gram because it's 5 times 31. So yeah, that's what
Well,
would happen.
Well, David, I'd say this: if gold, if it's a gold-backed currency, it's only a gold-backed currency if the backer is willing to buy that gold off you at 15,000 or sell it to you at 15,000. In other words, they're making a bid and ask at that price. Now, if the price of gold is bid at 15,000, I'll tell you, I'm going to buy it because I can't lose money. It can only go up.
Yeah, and I think what that will do though, it's gonna create a lot of the currency is gonna be debased and prices are gonna go a lot higher. But I think people's salaries and wages are gonna go higher too, just like they have. It's just gonna be over a shorter period of time, and they'll probably do that when things are in really bad shape, and they're already pretty much in bad shape when you have maybe a crash and deflationary collapse, like very quick. That's when they might do it.
Well, I think prices will go higher for the same reasons they've always gone higher, which is monetary debasement, and that's the reason that gold is going higher because they keep printing money. But it's not that a higher price of gold will drag up retail prices. That won't happen. So just putting the price of gold from 3,000 to 5,000 or whatever higher number we care to name, that will not change retail prices at all. because it's although we've in our minds we say our gold and retail prices they go up together, but the reality here is they're completely different things. The retail prices, yes, they will go up, but the only reason they'll go up is if suddenly everybody on the planet is getting higher wages and the cost of making things is going up. Now that's not going to happen overnight just because the Treasury has got a whole bunch of money out of thin air. It just doesn't.
Yeah.
It doesn't happen. Of course, they can spend more money on social security. Then some people have got a bit more money. They can buy a few more pizzas and iPhones or whatever they like to buy. But it's not going. You can't in today's world. You can't drag up the consumer price index unless the costs of manufacturing things are rising. That's cost push. Because the ability to expand the supply is almost infinite in today's world.
Yeah, I agree partly with that, Clive. I'll have to say that I think if they revalued to 15,000 pounds or $20,000, it would eventually create a lot of liquidity. The governments will have a lot
They'll
more
spend it. Yeah,
money to
yeah, they'll
spend it,
spend it.
and it's going to seep through.
Yeah, it
Just
will. It
like it
will.
has, you go back to 1971,
But
it was 35 an ounce, and you could buy a car for $2,000, I don't know. And
but
now,
but that's a money supply effect. I
yeah,
increasing the money supply. It's not a gold price effect. So if we put the gold price to 15,000,
yeah,
let's say
but
that's five
yeah, but
five
the
times what it
rise,
is. It
raising
doesn't
the
increase the money supply five times.
well, it would for the government if they revalue it because they'd get extra. They could borrow more, and by borrowing more, they can spend more, and that would increase the money supply indirectly.
So if they did it at $15,000, it would create $3.9 trillion. And I think the amount of notes and coins in circulation is something like $2 trillion. So yes, it could, if they spent it all immediately,
Yeah,
increase the money supply, pushing up prices. But I don't think prices. When you pump money into the economy, retail prices rise slowly. Asset prices like gold rise fast.
well, I hope you're right because then people who have gold are going to do very well if
Yeah, they
prices
will.
stay. And the other thing is, you could argue that AI, the effect of AI on prices and also on employment is going to be very deflationary. So it could counteract the deflationary impact of AI.
Yes, it might. It might welcome. That might mean that they can now give everybody a universal basic income without raising the debt,
Yeah.
which would obviously, as you say, help all these poor office workers who are about to lose their jobs.
Yeah, I'm not sure. I agree philosophically and also economically with UBI, but yeah, that might be a solution temporarily because I think people need to produce something and not be given things for free. But it could be in an emergency, don't you think, Clive?
Well, yes. I mean, I think the human nature is that they will try and produce things. So, but of course, there will always be that part of society who says, I don't have the ability, I don't have the skill set to do it," and they won't. But there will be plenty of people. So, it's going to. I just think we will end up with a situation where more people are on benefits or social support than we have at the moment as a percentage of the overall population. I think that's the direction of
Yeah.
travel because what we're seeing now is many companies which traditionally took on trainees, graduates, are now taking on a lower number because a lot of the work that the graduates used to do, for example, in the legal profession, they'd produce briefs for the partners. A lot of that work can now be done by artificial intelligence in a fraction of the time and with better quality than the graduates can produce. So the partners who are saying, "Do I really want to have another graduate this year?" Actually, I'd rather do it myself in 10 minutes.
Gold has been consolidating for a while, and I think maybe what happened over the weekend vis-a-vis Russia and the US and Ukraine might be quite positive. Scott, 49,140. Prices going up in the retail sector will be last. It will be a cause of the confidence being lost in the currency. Yeah. I mean, losing confidence in the currency, the currency will buy less. So that in itself is like makes, you need more currency to buy things. So that's higher price. It's like
Yeah, I
the
mean, you can imagine that in a particular situation, people suddenly fear that their money is not going to buy what it used to buy. They rush down to the shops to buy anything which will hold its value.
Yeah, it's like, during the Roman, when the Romans started debasing the denarius, they couldn't print, but they would put less silver into the coins. In the beginning, people didn't notice right away, but then people noticed that, well, this coin is not worth a denarius. So they would raise the prices. Yeah, but like you said, Clive, it takes a little while for people to twig onto it.
What emerges from this debate is a reminder that financial shortcuts often carry hidden trade-offs. Resetting the value of gold to astonishing levels may sound like a direct fix for government debts, but the chain reaction would ripple far beyond balance sheets. A sudden surge in official gold valuations would reshape global trade dynamics, tilt the balance of power between creditor nations, and unleash waves of liquidity that no policymaker could fully control. While it may provide temporary relief in the face of a financial storm, it risks triggering market distortions, accelerating price pressures, and undermining trust in the very system it aims to stabilize. The more pressing question is whether governments will resist such drastic measures until they are forced by crisis, or whether they will attempt to preempt disaster with an experiment that could be just as destabilizing as the problems it seeks to solve. Do you think a dramatic reset of gold's role in the monetary system would restore confidence, or would it end up creating a new era of instability just under a different disguise? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Additionally, if you are interested in Bitcoin-related news, consider subscribing to our other channel for more updates. Thank you for the support, and I hope you enjoy the video.